City Union Bank has slumped 16% on the back of its Q3 numbers. The net interest margins have come in at a six-quarter low of 6.88%, and slippages have seen a very sharp increase on a quarter-on-quarter basis. The company has also seen weakness in both deposit and the loan growth. To discuss the numbers, we're now joined by N. Kamakodi, the MD and CEO of the bank now. Mr. Kamakodi, afternoon, and thanks so much for joining in. Can we start by talking about the slippages? Your slippages are up 68% on a quarter-on-quarter basis. 439 crore compares with 261 crore. What explains this substantial increase that we've seen in slippages, and what's the run rate for slippages in Q4?
If you had a chance to look into our last 3-4 quarters, our slippages had been between 2.5 to 2.8%, or in terms 250 to 300 crore was the actual slippages we had seen. In fact, we typically used to have during pre-COVID period between 2 to 2.5%, which increased to about 3% during pre-COVID period, and things were moderating. We had a divergence due to RBI inspection, which we communicated to market somewhere in the last week of December. So we had about 259 crores of divergence, which was above 191 crore tolerance limit set. Based on that, like say, whatever we had recognized as NPA in the first 2 quarters and also after recovery, about 140 crores had to be as impact of that. Actually speaking, this is I feel this is one of the reasonably good quarters, in the sense that the entire shock we were able to absorb in the single quarters, post which even sequentially the net NPA has reduced, and also the coverage ratio has improved. This shock was because of that divergence, which we shared during the December. Going forward, things are moderating. We feel we should be having about 2.5 to 2.8% moderating, and almost all other numbers like ROA for 9 months, things have crossed 1.5%, and all numbers whatever we had shared is exactly in line with whatever we had shared in the past with the market.
Okay, Mr. Kamakodi, good afternoon. Surabhi here. Let me just reiterate that. When you said it will all moderate, are you saying that your slippage ratio will go back to 2.5 to 2.8? The market is probably a little worried whether there'll be more divergences. Maybe you'll have to take that absorption like you did this quarter. Could that be a recurring phenomena in the coming quarters as well?
Basically, in our history, this is the second time in the past 7-8 years the divergence has come, which is not a frequent phenomenon, which normally happens. It's an one-off phenomenon. We feel that it would not happen in the future, for which we are working with. So incrementally, almost we have reached the stage of pre-COVID level, and hopefully going forward, the incremental slippage ratio should be coming down. Another thing, the recovery from the NPAs have also improved. That's how we had about more than 80 crores recovery happened from the technically written off accounts. And that's what I said, since we had the sufficient wherewithal in the P&L, we were able to make provision for entire slippages, and also because of the divergence in 1 quarter itself. And that's why, even as your numbers say, between sequentially, the net NPA numbers have come down and coverage ratios have improved. And overall, the ROA numbers for the 9 months is 1.5, and all numbers are exactly on track compared to whatever we had communicated in the past.
Okay. And now, Mr. Kamakodi, hi, afternoon. When we spoke late December, you said the total credit loss on all of this will be between 25 and 30 crores on the divergence, 259 crores of divergence.
No, 40. No. Yeah. 40 crores was the provision suggested. Normally, our NPA recovery rate is about 75% of the slippages is what we have shown over a period of time. And the 40 crores was the incremental provision suggested for this divergence, which we have already observed, and also we have observed the entire divergence and still provided for full, and still our net NPA is sequentially lower, and overall ROA for 9 months has once again is back at pre-COVID level of 1.5% plus.
Okay. Okay. Fair enough. Mr. Kamakodi, otherwise is business, I mean, apart from this divergence issue, is business okay? Is it slow? I mean, very briefly, if you can tell us what's happening.
Yeah, basically we expected things to pick up and take the next phase of growth from December and fourth quarter on that front, which is getting postponed by, like say, particularly on the growth. And still we had 12% growth. Earlier we projected 15 to 18%. Maybe for the year as the whole, it has to be a tad lower. Apart from that, all the parameters and matrices, whatever we have generated, is almost equal to the whatever expectations we shared with the market by and large totally. So that's why all our return ratios still the ROAs and ROEs and net interest margins and things like that are almost in the range whatever we have communicated.
Mr. Kamakodi, just that one last quick point on the net interest margin. That's the market's other sort of disappointment, if I could say that. You've reported a decline in margins. It's come down to 3.88, which is lower than your last couple of quarters of average of 4+. Will this be reversed in the coming quarters?
In fact, no. See, we said it will be around, like say, we also had to not to recognize about 36 crores of income from the gold loan which we had communicated. Apart from that, all other front are by and large on the same line. And the net interest margin for 9 months is 3.97%, and we had shared that our margin will be between 3.85 and 4%, and our numbers are well within that range we had communicated.
Mr. Kamakodi, we'll leave it at that. Thank you very much for joining in. So City Union Bank, the three key takeaways are: 1, slippages will moderate in Q4. 2, growth could be slightly less than what they were earlier anticipating. They were guiding for a 15 to 18% growth, but in the first 9 months, they've only done a 12% growth, and net interest margins have moderated, but it's still within the bank's guided band of 3.85 to 4%. The stock is still down 16%. Get into a break, and more market talk is on the other side.